All right, let's talk about insurance. For over 100 years, it's been a massive part of financial planning. But what is it really? At its core, it's a tool designed to do one really important thing: handle the uncertainty that life is always going to throw at us. So, how in the world does it actually pull that off?
I mean, just stop and think about that for a second. A fire destroying your home, that's not just emotionally devastating, it's a potential financial wipeout. Trying to recover from something like that all on your own, that's a monumental task. And that right there, that's the exact high stakes problem insurance was created to solve. And of course, it's not just about house fires. Life is just packed with unpredictable events that can lead to some really tough financial losses. Insurance didn't just pop up out of thin air. It evolved as a super practical, really logical solution to manage these very real economic risks that every single one of us faces.
So, what's the magic trick here? What's the big idea that makes it all possible? Well, it's surprisingly simple, but man, is it powerful. It all comes down to one core concept: transferring risk. Okay, this might sound a little textbooky, but it absolutely nails it. Insurance is just a formal agreement, a legal contract, where you transfer your risk to someone else, in this case, an insurance company. You're essentially handing off the financial burden of a potential disaster. You're paying them to do the worrying for you. And this is where it gets really cool. It's all about a trade-off. See, you start with this huge, scary, and totally uncertain risk hanging over your head. You then trade it for a small, manageable, and totally certain cost. That's your premium. In return for that premium, the insurance company agrees to take on your big, uncertain risk. You're swapping uncertainty for certainty. It's a fantastic exchange when you think about it. So that explains the one-on-one deal. But how does the whole system stay afloat? How can an insurance company even afford to take on so much risk from so many people? This is the secret sauce: pooling. Imagine everyone with home insurance paying their premiums into one gigantic fund. Now here's the key. Most people won't have a disaster in any given year. But for the unlucky few who do, that huge shared pool of money is sitting right there to cover their losses. So the risk isn't just transferred from you to the company. It's spread out super thin among a huge group of people. And the difference this makes is just staggering. It's night and day. Without insurance, a major loss is 100% your problem, every single dollar. With insurance, your only responsibility is that small, regular premium. The insurer steps in and handles the rest. It's the ultimate financial buffer. And that's really the crucial point. The whole system is designed to give you access to a massive amount of financial protection. We're talking hundreds of thousands, even millions of dollars, all for a relatively small, affordable fee. That's the core value of insurance, right there. But hold on, there has to be a rule to keep people from abusing the system, right? A principle that makes sure it's used for protection, not for profit. Well, there is. It's called the principle of indemnity. This quote gets right to the heart of it. The goal of most insurance is not to make you rich, it's to make you whole again. It's designed to bring you back, financially speaking, to the exact same spot you were in just moments before the loss happened. In other words, if you suffer a $50,000 loss, the insurance policy is designed to pay you $50,000, not $75,000. It's all about reimbursement and restoration. This prevents anyone from profiting from a misfortune, and that's absolutely key to keeping the whole system stable and fair. Now, it's important to know that not all contracts work this way. Most policies, think property or health insurance, are indemnity contracts. They reimburse you for the actual calculated loss. But something like life insurance is different. Those are called valued contracts, and they pay a specific, predetermined amount of money when the event happens. And why is it different? Well, because you can't really put a financial price on a human life, can you? So instead of trying to reimburse a loss, a life insurance policy pays out that set benefit. The goal is to create an instant estate to provide financial security for the surviving family members who depended on that person's income. So when you put all these pieces together, the risk transfer, the pooling, and the principle of indemnity, you get something truly powerful, a predictable plan for a totally unpredictable world. The benefits are just so clear and practical. Insurance transforms the possibility of a devastating, unplanned expense into a predictable, manageable one. This gives you peace of mind, it lets you manage your cash flow way more effectively, and ultimately, it just gives you more control over your financial life. And that's really the bottom line. Insurance isn't just some product you buy or another bill you have to pay. It's a strategic tool. It's a foundational piece of any solid financial plan. providing that safety net that allows you to build for the future without the constant fear of being knocked off course by one single bad event.
So, understanding the how and the why behind insurance is the first step. But the next and really more important step is thinking about your own situation. And that leaves us with a critical question to think about. What are the uncertainties that you face, and what's your plan to manage them?